This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Chapter 10 deals with financial performance measures, and much of this is going to be revision of financial ratios which are met in previous papers. So here are two of the groupings of ratios. And what I have to say at the start is you have to look to see what the question says to see which ratios are going to address the specific issues which have been raised. So obviously if you're dealing with will the company continue trading, is it safe, you'll be looking at liquidity and gearing. If you're looking at profitability, we have the profitability ratios, and then we'll see on the next slide that we have got investor ratios as well. So the return on capital employed. What is the return on capital employed? Well, it is the net profit. It's before interest and tax. So it's a profit before interest and tax divided by the capital employed. And the capital employed is the share capital plus reserves plus long-term loans. So it's a profit before interest and tax divided by the capital employed, share capital, reserves, any preference shares if there are any of those, and long-term loans. Gross profit percentage is the gross profit or trading profit divided by sales. Net profit percentage, sometimes called operating profit percentage, is the operating profit divided by the sales. And really what connects these two here is going to be expenses. And I often find it quite worthwhile to work out expenses over sales, because if that ratio rises, it kind of implies that the companies are getting bigger, but they haven't kept the expenses in proportion, that perhaps some of the cost control isn't as good as it might be. Liquidity. Liquidity looks very much at whether or not the company is going to be able to pay its way and to pay its liabilities really as if fall due. The current ratio, if you remember, is current assets over current liabilities. By and large, people like to see that a bit over 1, although it does depend on the type of business that you're in. If you're renting lots of properties, then you're almost guaranteed to get most of that rent coming in. So you can plan your cash flows very well. You can live with quite a low current ratio. If, however, your income is up and down all over the place, but of course a lot of your current liabilities, a lot of payments have to be made every month anyway, then you probably need a higher current ratio to allow you to survive the tough months. The big question mark in the current ratio is how quick will inventory be sold and then eventually turned into cash. And that's why it can be important to have a look at the quick or the asset test ratio. That's the current assets except inventory divided by the current liabilities. Again, if that's much below 1, people probably get just a little bit worried there. Buying stock is essentially the act of a volunteer. No one can guarantee that lots of inventory is going to turn into lots of receivables and then into lots of cash. Receivables, collection period, payables period, and days of inventory are all good type of housekeeping ratios to see how well they're managing the current assets of the business. The receivables period, if you remember what that is, the receivables period is going to be the receivables divided by the sales per day. How many days worth of sales are in receivables, in other words. The payables period is going to be the payables. And really what causes payables to increase is your purchases. So how many days worth of purchases are represented in the payables balance? And days of inventory it'll be the inventory. How long is it going to last? Well, you're using inventory through cost of sales, really, that consumes inventory. So ideally, it's going to be cost of sales per day. But if you can't get to cost of sales, then as an approximation, purchases per day will do. And in fact, it'll be identical if the inventory stays level. Cost of sales and purchase will be the same if the inventory doesn't change. People tend to get a bit worried in general if receivables collection period goes up. Are they losing control of receivables? But of course it might be a deliberate policy to give more credit, or they might have started selling more overseas and just the transportation of goods overseas takes longer and it's longer to collect those amounts due. Payables period increasing, you want to not pay too quickly, but if you begin paying too slowly, then your suppliers can get nervous. They may stop supplying or they may require cash up front. And days of inventory, again, if it increases a lot, you get a little bit worried. Have they made a purchasing error? Will they never be able to get rid of that inventory? Or it could be, again, a deliberate strategy. They're gearing up for a big sales push, and we just happen to pick a ratio, pick a balance sheet value for inventory when the warehouse is particularly full, waiting for the next month's, as I say, sales, what they hope for is a sales bonanza. The next set of ratios, we've got gearing ratios. Gearing looks very much at the risk. High gearing implies high borrowing. It implies you have a high amount of interest to pay every year, whether or not the profits are going to be there. And the common ones, the gearing ratio, is either long-term borrowing over equity, or it can be long-term borrowing over equity plus long-term borrowings. It doesn't matter which is used, as long as you are consistent from one year to the next. So basically, equity over debt, book values, or equity over equity plus debt, book values in all cases. Myself, I find interest cover particularly useful. Interest cover is the number of times you can pay interest. So basically it's your operating profit. That's out of what you're going to pay the interest out of divided by the interest. So if you're up around 10, you could pay the interest 10 times. No one is going to be very nervous about that. If you're down at about 1.5, it means all or nearly all of your operating profit is consumed by interest. The operating profit just has to fall a little bit or interest rates rise a little bit, and you could be going to be in some trouble meeting these obligations. Remember, interest is a problem because it's a fixed cost essentially. You have to pay it whether or not you make profits. But similarly, operating gearing here, it looks at fixed costs. Various sorts of ways of looking at it here. You can have fixed costs as a proportion of total costs. Or sometimes you might see fixed costs over variable costs. But it is a measure of how much of your costs, what proportion of your fixed costs, what proportion of your costs are going to be fixed. High operating gearing, so lots of fixed costs, maybe rent of a factory, rent of shops, lots of employees on fixed salaries, lots of machines being leased, so you have to pay those costs even if they're idle. High operating costs, high fixed costs means your operating gearing is quite high, and if your profit falls just a little bit, it could be very hard for you to pay the rent, the leases and the salaries. Investor measures, price earnings ratio, that's price per share over the earnings per share. So price per share divided by the earnings per share. The only way you can really judge this is by looking at similar companies. And this is something which really only works with listed companies. But if our company had a PE ratio of, let's say, 12, and the industry at, say, PE ratio of 9, we have to think, why are investors pricing our company quite highly? In the industry, the share price is 9 times the earnings, but for us, the price is 12 times the earnings, or 12 times the historical earnings. And this situation would mean that really some sort of growth is expected. Last time's earnings were a little bit poor, but we're willing to pay a high price for this particular company because we expect next year's earnings to be much higher and for the PE ratios then to be brought back to be more normal. Similarly, a PE ratio which is below the industry average tends to imply that people expect a rather poorer future, that next year's earnings and so on are going to be depressed a little bit, and that's why the PE ratio has been brought down. Earnings per share is a useful one. Looking at dividends or dividend yield here is a little bit arbitrary. It depends on the dividends that have been declared, and this is basically the dividend per share over the share price. But the directors can move the dividends up and down. They can manipulate this sometimes. So even if profits fall a little bit, directors can keep the dividends up or even increase them to keep the dividend yield high. But there's no fiddling around with earnings per share. It is the earnings available to the ordinary shareholders divided by the number of shares. And you want really to see that a nice steady increase. It means that per share the company is producing more profit. Whether or not that is actually distributed in dividend is another matter. I think we have covered expenses over sales. We don't need to do that one in there again. Remember, the key to all ratio analysis is really comparison, comparing to previous years of the same company, sometimes comparing to similar companies, sometimes comparing to industry averages. Here's the example from chapter 10. And what you're asked to do is to decide whether or not these figures, 4 years worth of figures, support the contention that the company has managed to increase shareholder wealth. So shareholder wealth we're looking at, which will mean that ratios such as receivables collection period, current ratios, even gearing perhaps, aren't going to be directly relevant to that. We're going to be much more interested in the things that shareholders maybe really care about, which could be share price, could be earnings per share, could be dividends, could be the profit made by the company overall. We have to be a little bit careful because as we go through this line here, when we look at the number of shares in issue here, it's gone from 9 up to 12. So, and it says that there's been a rights issue sometime in year 3. And obviously if you issued shares to kind of double the capital of the company, you would really expect profits to increase in a similar sort of proportion. So when we talk about have they increased the wealth of shareholders, I think we're talking about a given shareholder or a shareholder with a set number of shares in there. Because obviously if you subscribe to a rights issue, you're putting more money into the company, and you're a bit disappointed if the value of your shares hadn't therefore risen. So what should we look at? Well, let's look first of all at turnover. Turnover has increased very substantially there. A very large increase in turnover seems really quite good. We could work out the percentage increase in turnover. Of course, this itself doesn't mean anything. We have to look at other things as well. But 59,000 minus 43.8 divided by 43.8. It looks like about a 35% increase in turnover over the 1 to the 3 periods, the four years. So that's pretty good. What about the, we could work out gross profit percentage. Well, why not do that if we have time in there? So the gross profit percentage is, the gross profit is going to be the difference in there. So it's 43.8 minus 16.6, 27.2. And if we divide that by 43.8, it's looking at about 62% as a gross profit percentage. And over here, we're making a gross profit of 59 minus 22.9, 36.1, nice increase, divided by 59, it's going to be a 61% in gross profit percentage. So we've gone from 62 to 61. It's about stood still really, which is perhaps okay. What about the net profits? How have they increased? Here we have 8.7. Here we have 11.3. So 11.3 minus 8.7 divided by 8.7 shows we have there about a 30% increase in net profit percentage. A little bit disappointing. Our sales have increased 35%, but our profits, our net profits, have only gone up 30%. It implies we're maybe losing ground a little bit in terms of holding on to, control of expenses. We look at the profit after interest and tax, 51 up to 755, so 7.55 minus 5.1 divided by 5.1, it's a 48% increase in there. And the main reason for that very large increase is, of course, that the interest has fallen away. We have issued shares, and presumably this has taken the place of refinanced some loan capital. And it's very good indeed to see that the profit after interest and tax has increased massively. This is the profit that's going to be available to the shareholders. And once we're there, we can actually work out the earnings per share there. So the earnings per share here, it's going to be 87, or 8.7 if I do it in thousands, divided by the number of shares, divided by, in there, it's going to be 9. So number of shares in issue is going to be 9,000. The big one, we can't work out the earnings per share there. It's down here, of course. It's profits after the interest and tax. It's 5,100 over 9,000. So 5,100 divided by 9,000 is going to be 0.57. What do we get in earnings per share out here? Well, earnings per share out here is going to be the profit after is going to be 7,550 divided by, now there's 12,000 shares in issue. And that's why it's important to look at earnings per share, not just profits growth. Any fool can make profits grow if you simply, get more capital coming in. So 7,550 divided by 12,000 is going to be about 63. That's very good. Earnings per share increased from 57 to 63. That really is increasing, or should be increasing, the wealth of the shareholders. We can use this to work out the share price. So here we have a PE ratio. So the PE ratio, we take again this one here, for this company, which is Repsay 17, equals the price per share over the earnings per share, 0.56. 0.57. Okay, so the price is going to be 17 times 0.57. It's going to be about 9.69. Over here, the same idea, we have the earnings per share of 63 or 0.63 here, and the price here is going to be the PE ratio, which is now 19 times 0.63. So the price per share there, 19 times 0.63, it's going to be 11.97. So roughly speaking, gone from about 9.7 to about 12 over the basically the three-year periods in here, 1, 2, 3, and that's quite a nice little kind of an increase. So roughly speaking, it's going to be 12 minus 9.7, and if we divide that, so that is divided by 9.69. That's about a 24% increase. We seem to be increasing share price at around 7-8% per annum. We need to find out what inflation is, of course, to see whether or not I was keeping up with it, but things are looking good so far. And we see here that the PE ratio started off below industry average, and now it's above industry average. So this is implying that there are even more good things to be coming in the future. All told, I would say that the company has managed to increase shareholder wealth. It has done good things for its shareholders. We've seen that the earnings per share has increased. We've seen the profit, the net profit percentage has increased very substantially there to 48% in here, or 48% increase rather, from here to here. The earnings per share, as I said, have increased very nicely indeed from 5.7 to 6.3. The share price has increased from about 9.7 to 11.97. The PE ratio is looking very optimistic. So I would conclude that by and large the company's done really quite well. So here are the questions relating to Chapter 10, which you should have a look at.